Hello and welcome. I'm Nicolette Pomba-Van Editor-in-Chief of ESI Africa, and my task for today is to guide you through this industry insights discussion that was inspired by our latest finance and investment volume. The volume is available online and is published with thanks to our partners IcoSolar, GE Vernova, and South African Airways. To set the scene, allow me to mention that Africa's external debt is estimated at 1.1 trillion US dollars, and around 163 billion US dollars is spent annually servicing this debt. The challenge is that most African countries are rated at sub-investment grade, which for the most part is based on perceptions rather than fact. This junk grade rating translates into high-risk perceptions for investors, which creates unfairly higher borrowing costs. So for our conversation today on overcoming Africa's credit risk, I'm joined by two professionals conversant in the topic at hand. So audience, please join me in welcoming Ejigayo Tafera, the Senior Credit Rating Researcher at the African Peer Review Mechanism, and Marvelous Ngundu, the Research Consultant into African Futures and Innovation at the Institute for Security Studies. Before we get into this conversation, audience, please have your mobile phones handy to snap a QR code to participate in our upcoming poll questions. Also, please use the comments box on the right-hand side of your screen to send your queries to our guest speakers. Now, to start the discussion, Ejigayo, please introduce yourself and present your thoughts on how foreign credit ratings impact investment flows into Africa.
Thank you, Nicolette, and thank you for ESI Africa for inviting African Peer Review Mechanism. My name is Ejigayo Tafera, and I am a senior researcher in the area of sovereign credit risk. I work with the African Peer Review Mechanism, which is an institute of the African Union, and we were established back in 2003, and we are mandated to promote good economic and political governance policies in Africa. To answer to your question, sovereign credit ratings or credit ratings in general are quite key in determining investment flows, because this is an indication of how well the economy is, and also the borrower's ability to be able to to pay back the borrowed amounts as well as the interest rate. So investors look into credit ratings to determine whether the economy is investable or not. The unfortunate part, like you said, Nicolette, in your introduction, in Africa, out of our 55 member states, it's only 2 countries who have good investment grades. So that tells you the scale at which sovereign credit ratings have had so far disproportionate impact on Africa in terms of being able to exploit the investment potential of the continent.
Thank you so much, Ejigayo. It's really interesting that there are so few countries that actually are in a position to say we want your investment and we can get that investment at a reasonable rate. So Marvelous, kindly introduce yourself and tell us about the key factors contributing to high credit risk in African countries.
Thank you, Nicolette. My name is Marvelous Ngundu. I'm a research consultant at the African Futures Innovation Program. So what we do in a nutshell is that we focused the future of Africa using 8 thematic areas that you can find on our website. And for this webinar in particular, I'll look at the financial flows, which covers the Africa's credit risk. And back to your question, Nicolette, what are the key factors contributing to high credit risk in African countries? One thing that we have to acknowledge is that credit risk is not just a financial metric in Africa. It represents a significant barrier to the continent's ability to attract sustainable investment and finances, especially for infrastructure projects. So, understanding its root causes is crucial for unlocking the economic growth potentials of African countries. So, but before we delve into these causes, it is good also to acknowledge that high credit risk leads to high borrowing, leads to short-term maturities, leads to limited access to finances, especially for small to medium enterprises, and also it deteriorates the investor's confidence, which stalls progress across sectors such as energy, such as infrastructure development, transport, ICT, manufacturing, and agriculture. But there is no single cause um, that we can pinpoint, Nicolette. Um, there are several interlinked factors that contribute to the elevated credit risk profile across many African countries. For instance, the macroeconomic volatility within the African countries, where many African countries experience high inflation, they experience volatile exchange rates, heavy reliance on the commodity exports. So these shocks, Nicolette, they weaken the fiscal space and also increase sovereign risk, ultimately impacting the credit worthiness of both the government and also the private sector. We have also the issue of weak institutional framework within the African countries, which covers the issue of the enforceability of contracts, the lack of credit rights, and also inefficient judicial systems. All these issues make credit recovery very, very uncertain and volatile. So this discourages then lenders and investors would then price this uncertainty in their lending terms, thereby increasing the African premium, so to say. Then we also have the issue of limited credit data. So in many countries, what happens is that there is lack of robust credit bureaus and financial reporting systems. This makes it very, very difficult for financiers and creditors then to come up with a realistic credit rating based on verifiable data which they can gather, be it from the African governments or from the private sector. Then now we have got another issue of the currency risk. Many African currencies borrow in foreign currencies, right? Yet they earn revenue in their local currency. So that exchange rate fluctuations can quickly rise debt services cost and also increase default risk. Then finally, Nicolette, there's issue of the shallow capital markets, and people underrate this. Domestic financial markets in Africa are often underdeveloped. The only markets that we can talk about in all African countries is the JSE, the Kenya, and the Egypt, just 3 out of 54 countries. That's underdeveloped with the limited long-term instruments. So this means borrowers are more exposed to the external shocks and the global trade fluctuations. So, from a financial economics perspective, the interaction between all these factors, they play a critical role in determining the creditworthiness of the African countries. Ultimately, reducing credit risk in Africa is not just about de-risking an individual project. It's about building trust in the ecosystem of Africa as a whole. And that's something we can work towards together across all the sectors and all the borders. Thank you, Nicolette.
Thank you so much, Marvelous, and for mentioning the fact that there is a lack of data. This is a challenge that then lends itself to people rather looking at the perceptions and not having that data to be able to say these are the facts. So that is so important. Audience, we are now going to present our first poll. And as I mentioned, it is based on a QR code. And depending on which phone you're using, it's either use your QR code app or just snap a photograph of this QR code. And the question is, which African region do you think has the highest credit risk? And you've got your various regions as your selection there: West Africa, East Africa, Southern Africa, Central Africa, or North Africa. And while you are taking that poll, we will continue the discussion. So, Ejikewu, while our audience is taking that poll, let's turn to the policies and regulatory frameworks that we need to be aware of. So, E.g., what policies can governments implement to improve a country's credit worthiness?
Thank you, Nicolette, for that question. In terms of policy, when we look at many of the ratings and the comments or the recommendations they put forward when they issue ratings, there are quite a number of recommendations to be taken into consideration and some reforms to improve, the fiscal management of the country. Debt management strategies needs to be, put in place in order to make sure that debt is sustainable in the country. But when you look at the regulatory frameworks, generally in the African credit rating space, through the work that we have been doing, what we have uncovered is that there are only about 21 countries who've got some sort of legislations that govern credit rating activity in the continent. And most of them, they don't even have a mandate to cover rating agencies that operate outside of Africa. And as you know, many of the rating agencies, especially the top 3 rating agencies, they do not domicile in Africa. They operate outside of the continent. I know Moody's and Standard and Poor has got an office in Johannesburg because there is stricter regulatory requirements in South Africa than the rest of the continent. But there is a huge gap in terms of filling in that or setting up that regulatory framework. Continentally, yes, I believe that will be the long-term goal. But in the meantime, countries also need to set up some sort of framework that govern the operation of rating agencies in the continent.
Marvelous, do you want to maybe weigh in on the policies that you believe would improve creditworthiness?
Definitely, Nicolette, and thanks to my colleague for highlighting the issue of fiscal discipline and debt transparency. It's one of the vital issues. But I'll break this question perhaps into 3 parts. Number 1 is to look at the policies to improve creditworthiness, which partly Ichiko has covered. Then I'll look at how effective have recent reforms that have been implemented by some of the African countries did they succeed or not, and perhaps lessons from other regions. So when it comes to the policies to improve the credit worthiness, the fiscal discipline is paramount, and debt transparency is it's vital. African countries must maintain sustainable debt levels, must improve public financial management. They must publish verifiable uh, debt related data so that investors can gain confidence on their internal operations, on their debt structures, and also on their performance. This alone, it reduces the risk premium. Then we have also the issue of domestic revenue mobilization, which should be done through like broadening the tax base. So what we find out is that in Africa we have got the highest informal sector, which are unaccounted for on the formal tax base. So we should address policies that will formalize, that will initiate the formalization of the informal sector to broaden the tax base, to enhance the collection systems, and to reduce dependence on the volatile commodities like export of commodities. This can help then to stabilize the public finances and reduce high dependence on external debt borrowing. Then the other issue that I'm thinking of is strengthening institutions, of course, and the issue of rule of law. We need clear legal frameworks because the issue of institutional quality is so volatile and sensitive when it comes to credit rating. Anything that happens which impact the institutional framework, it does have a severe impact on the credit rating. So Africa should take careful uh, reforms when it comes to the issue of institutions. Then the issue of also of de-risking instruments and blended finance, where governments should partner with like the development financial institutions to structure guarantees, insurance, co-investments that share the risk with the private lenders and also encourage the credit flow. The other thing that I can think of is also developing what we call local currency debt markets, like issuing local currency bonds and developing pension fund, what you call it, they call pension fund participation and reduce foreign exchange exposures. So how effective have these initiatives in other countries? I can think of Rwanda and in Morocco, which have improved credit profiles through just sustained macroeconomic discipline and also institutional reforms. Think of Egypt, which have implemented the International Monetary Fund, support fiscal reforms, and improved its credit ratings by several notches for the past decade or so. Think about Ghana, before its debt distress in 2022, it made a notable efforts in capital market development. It also made a notable efforts in credit market transparency. Think about Zambia, just close to us here, which has its, of course, the credit rating for Zambia is still weak, but it has improved just by improving its institutional reforms and also a combination of factors like debt restructuring, improved fiscal performance, and etc. So we should acknowledge that, of course, there are challenges coupled by the COVID-19 and also the issue of the political instability, but these reforms do work. Then lessons from other regions. Let's think about the countries like Peru and Chile in Latin America that have implemented like strong fiscal rules, sovereign wealth funds, and also transparent debt management offices, which have helped them to reduce like the issue of sovereign risk and also maintain what you call it, investment grade ratings. Think of countries like Vietnam and Indonesia in Asia, which have focused on export diversification and FDI friendly policies. and building resilient banking system, by the way, allowing them to steadily climb the credit risky ladder. So what are the takeovers from your question, Nicolette? Number one, we need to be consistency. Long-term credibility builds over time. Ratings improve with sustained reforms. It's not an overnight job, not one-off job. Then we need also transparency. Transparency is a reward. Open communication with the markets and credit rating agencies, it can reduce uncertainties. Thank you so much.
Thank you so much, Marvelous. I want to move on to another question for Ejike around the lessons that African countries can learn from other regions. And Marvelous, you have mentioned a couple here, and I saw, Ejike, you were nodding, so I think that you are familiar with them. So what can you add to what you know, how those countries have been able to uplift and improve their credit ratings?
Thank you, Nicolette. Like my colleague Marvelous has mentioned, credit rating, improving credit rating, it's a journey. It's not a one-stop, one-time activity that countries do and expect miracles to happen overnight. It's a continuous process and reforms that needs to be undertaken in order to show that there is some level of consistency in terms of policy implementation in the country, and to show that the macroeconomic prudentials in the country are also stable, and it is showing improvement. But also one of the approach that we have taken, and the work from our experience and countries whom we have supported told us that interaction with credit rating agencies is quite key, and it is something that we have been lacking, because countries do not take this exercise quite seriously. They do not give it the emphasis that it deserves. They are asked to provide information or data. They may not provide it on time, which is playing out against the country's interest and reflected in the ratings. So taking the rating exercise seriously, and we have actually been insisting on setting up a liaison team, and that can be between the Minister of Finance and the central banks, who will be the liaison team that interacts regularly with rating agencies, provide feedback, provide the information that they are looking for, and be able to be as efficient as possible. Because often the rating agencies themselves are complaining about not being able to get the data that they need. So they will have to rely on the information that is available publicly to make their own assessments and judgments. So these are steps that we think are easily achievable, that governments can easily tackle to be able to improve their credit worthiness.
Mm-hmm. Thank you so much for commenting on that. And just a reminder to our audience that you can pop your questions into the comment box, and we will pose the questions to both Ejike and Marvelous. So a question for you, Marvelous. In terms of international financial institutions, how can organizations like the IMF, the World Bank, and the AFDB help African countries enhance their credit status?
Thank you, Nicolette. That's a very critical question. So the role of DFIs, development financial institutions, that you indicated, the World Bank, IMF, is very important. So I'll group these roles into two. Number one, the strategic role. The strategic role of enhancing credit status of the African countries and Africa in general. Number two, reducing the perceived risk. They have got a role of reducing the perceived risk through financial instruments and guarantees. right? I'll go to explain the number one role, the strategic role of enhancing credit status. So what they do is to reduce the credit status through policy support and reform incentives. These institutions provide like technical assistance, like policy guidance, and also conditional support that encourage macroeconomic stability, fiscal responsibility, and also transparency, which are the key factors that influence the credit ratings, by the way. I can think, for an example, the IMF programs, even the World Bank is also that program, which include targets or threshold. For IMF, the current threshold, debt level threshold, should be about 55%, and for World Bank is 60%. So African countries need to adhere to those debt sustainability threshold, and I'm glad that out of 54 African countries, only 3 countries have exceeded that threshold as according to 2023 figures, which is Zambia, Djibouti, and Cape Verde. Most of them are still under 55%. Then there's also World Bank's governance and public finance reform programs uh, that assist in building the institutional credibility needed for long-term market confidence. Then we can think also for initiatives like credit enhancement through ratings dialogue, and my colleague has indicated that these institutions they encourage like the direct communication between the credit rating agents, the government, and the private sector. So it helps to interpret reform progress. It also helps to contextualize risk so that the government and the private sector knows exactly what is expected by these credit rating agents. And this is especially important for countries with limited market access or misunderstanding of the risky profiles. So let's now go now to the issue of reducing the role of reducing the perceived risk profiles. So what they do, the DFIs, development finance institutions, they offer like a suite of de-risking tools to attract private investment. I can think of the partial, what they call the partial risk guarantees, or PRGs, which cover specific risks such as government default or regulatory changes, especially valuable to infrastructure projects and also energy projects. One example of that is the one that is being offered by the World Bank's group, which is called International Development Association, IDA, and International Bank for Reconstruction and Development, IBRD. They offer guarantees that have supported energy and transport deals across Africa. Then we have also partial credit guarantees, PCGs, which are used to enhance sovereign or corporate bond ratings by covering, like, for instance, debt service in case of default, and also helping countries across Africa, which have got less access to low cost capital. The one example that can come into my mind is the African Development Bank's partial credit guarantees, and it have helped Nigeria to issue local currency bonds to finance its infrastructure development projects, by the way. Then we have got also the political risky insurance, the PRI, which have which is offered by these institutions through the multilateral investment guarantee agents, MIGA. it's also the part of the World Bank group. So what they do, these political risk insurance, they protect investors against the risks such as expropriation, the breach of contract, or civil disturbances. Then finally, we have got the issue of blended finance structures, where DFIs are concessional capital to crowd, they offer concessional capital to crowd in private investments, lowering the risk return threshold for commercial players. So this include the first loss capital, also the volatility gap funding, or co-investment vehicles with development institutions anchoring the structure. And the last one is just beyond financing, Nicolette. By integrating with these DFIs, it gives some sort of credibility to that particular country to say there's a project that have been conducted in integration with IMF, with integration with World Bank, in integration with the African Development Bank. It gives some sort of a credibility in that particular country. And this is especially powerful for the first time issuers of frontier markets. And then a key thought on that, to truly scale investment in Africa, we need to align reforms, we need to align risk sharing instruments and multilateral credibility. So DFIs, in a nutshell, are essential, not just for funding, but for building the bridges of trust that investment flows across African countries. Thank you, Nicolette.
Thank you so much, Marvelous. I do also want to touch on the fact that there are all of these solutions or tools on the table that are available, but are governments finding it difficult to access these? Ejike, would you like to weigh in on that?
Definitely. So yes, there are different financial instruments, and DFIs are a critical, a critical part of this ecosystem. They can extend, concessional loans apart from obviously, those blended financing options. But the amounts are limited. I don't know if we should go that deep, but there are movement at the moment, and questions around African countries having more drawing rights in IMF, because you can only have that package or the amount that you actually contribute to. But there is actually quite a significant amount of funds which are not being utilized. So the question has been, how can we reform this financial system in order to be able to give more access to African countries or countries in the South who will need this financing, but they have not been able to access it just by the virtue of not being, being given that right to access a fund. So the awareness is there. Countries, our development need is growing, our population is growing, and the financing options also need to grow, and the amount needs to grow. But we are quite limited with how much we can access in terms of our drawing rights from these financial institutions. The other point, which I also find it quite interesting, when Marvelous was talking about the blended financing option, more than anything else, Africa's risk and perception of risk is generally high. And this is not just a sentiment, but it is something that has been proven through different research. So the development financial institutions have got a bigger role to play in terms of, giving that confidence for private sector. Look, Africa is investable, and in fact, there is higher return in Africa than everywhere else. So that is the part that I think they can, play much more than they are doing at the moment.
Thank you so much both for weighing in on those questions. It's time now to have a look at the first poll results, and I am going to ask both of you to give your comment on this. And it looks like there is definitely people who are thinking that East Africa and Southern Africa, wow, with Central Africa at 50%. So looking at those figures, Ejikeyu, what is your personal feeling, and why do you think we are getting the results that we are from the audience?
I believe it has got to do with the current political climate and the instabilities that we have been seeing in Central Africa. Yes, there is, when you look at the methodology of credit risk assessment, yes, there are those macroeconomic indicators, but a big part of it goes into political risk as well. So the risk perception at the moment, when it comes to political risk, is quite high in Central Africa than anywhere else in the continent. So it could be the reason why participants think that there is a highest credit rating risk in the Central African region.
And Marvelous, your thoughts?
Thank you, Nicolette. Yes, I do agree with my colleague. The governance. So if you look at the Central Africa, most of the countries are involved in civil wars and stuff. That alone, like what I said in the beginning, that it lead to, in fact, a small margin fall in any government's indicator. It has got a severe impact on the perception of creditworthiness. So looking at Central Africa, most of the people think that it has highest credit risk is because of the issue of the governance that has deteriorated drastically. We have got high civil wars happening there, unstable politics, and of course the macroeconomic volatility that has affected quite a number of Central African countries. Then North Africa, I see now the statistics has changed, but initially it was 0%. It's a matter again of macroeconomic stability and also the governance. So if the macroeconomic variables indicate stability for the foreseeable future, and also if the governance is stable, indicating some stability for in the long run, that alone is a strong message to the investors.
Right. Thank you so much both for weighing in on that poll question. So audience members, it is now time for our second and final poll question for this webinar. The question, if we can get that up on screen, please. The question that we are asking you is, would you consider investing in African sovereign bonds this year? And you will have 4 options there. That is, yes, you would take up this opportunity, or no, you think it's too risky, or maybe because you want to be very cautious, or that you are not sure. So we will keep that poll question up for a little bit while we continue with the discussion. But before I pose the next question, I do just want to let everybody know that ESI Africa will be attending Inlet Africa next month, where we are hosting a studio, and there will be conference sessions that we will be attending that lean towards finance and investment, not just credit risk, but also looking at how private sector is investing into infrastructure development in Africa. So that is a conference that you might be interested in attending. Continuing with the discussion, Ejikeyu, what role, if any, can the private sector play in de-risking African economies?
Thanks, Nicolette. The private sector in the continent is not, it's still growing. It's still at its, infancy stage, but it is growing. Our economy is quite huge. It's almost $3.3 trillion dollar economy. The total combined GDP of the continent. And yes, our private sector is still, at earlier stage of development, but it is growing. And I think for African economies to grow further and to sustain this growth, we really have to have the private sector driving the economy. And when you look at the capital market, for instance, our capital markets, I think my colleague Marvelous has mentioned this earlier on, they are quite shallow. They are not that well developed. There isn't that confidence in the capital market, and in there aren't that many investments that we would want to see. The private sector has a huge role. It's still in the earlier stage of development, but that's where we hope that all the jobs to be created, to drive the economy forward. However, we are still at the early stages of that development. If you look at also the corporates, 90% of the corporates in Africa are not rated. And that is partly the reason why our private sector is not growing as much as they should be, because they cannot get the funding that they need to scale up their operation. So basically, increasing the private sector's involvement in the economy is quite crucial, and no doubt, and private sector should be the driving force of the economy, and that is happening, but not in the scale and at the level that we all want it to be yet. But yes, definitely.
Nice. Thank you so much. Here's an interesting question around digital financial solutions, which I'd like to pose to Marvelous. How do you see digital financial solutions and fintech contributing to de-risking markets?
Thank you, Nicolette. Quite interesting. Yes. So the issue of fintech is the most effective tool that is available to shift risk perception and mobilize private capital for African economies. But how it works? So it combines the issue of concessional capital from donors and DFIs with commercial capital to improve the risk-adjusted returns. I'll indicate the example of the Africa Guarantee Fund, which provides partial guarantees to the small to medium enterprises and also encourage banks to lend. And also the issue of the Sustainable Development Investment Partnership, which structures the deals to crowd what they call institutional investors for African infrastructure projects. But one of the fintech tool that have used for that instrument in particular is the green and social bonds, and we should emphasize the importance of the green and social bonds in the fintech because it has contributed quite significantly in the current era. So what the green and social and sustainability linked bonds, they are also called GSSS plus, are more than just a buzzword. What they do is they offer African countries a way to lower the cost of capital, a way to diversify investors' bases, and also demonstrate long-term commitment for responsible governance. And the benefits that they've offered in the number of countries that have been engaged in these bonds is to enhance like transparency through impact reporting. That's one thing that is important, and also to use what you call it, IMF and the World Bank guidelines that builds investors' confidence. The other thing that I can think of that fintech does contribute, or the new financial solutions does contribute, is the access to ESG, environmental social governance tools focused on capital pools, which are growing rapidly, and they've often more risky tolerant than any infrastructure loans that we can think of. Then the also issue of improved reputation and signaling, like issuing credible green and social bonds that can support a better credit narrative, rather than just relying only on perceptions over time. So I can think of examples like in Nigeria. Nigeria issued Africa's first sovereign green bond in 2017, if you remember, to finance solar and also forestation projects. Then there is also a bond that was issued in Benin. It was an SDG bond that raised something close to 500 million euros in 2021, which helped in boosting its visibility with sustainability aligned investors. And in South Africa, there's quite a number of green bonds that have helped to finance like rail, clean energy infrastructure projects. But over and above, these instruments align Africa's financing needs with the global sustainable priorities, making risk more manageable and also more accessible to both the government and the private sector. Then, just on a small scale basis, there is something called M-Kopa in Kenya, which uses pay-as-you-go models and mobile money to build like credit profiles for low-income earners. There's also Carbon in Nigeria, which offers instant what you call it, macro loans, using like smartphone data for credit scoring. There is also Tala. This one is quite famous because it's being used by several African countries, which is called Tala and Branch, which have scaled like macro lending across multiple African markets using digital footprints. So as digital ecosystem mature, Nicolette, fintech is helping turn Africa's data deficit into data dividend, and lowering information asymmetry and also unlocking credit. Thank you so much.
You've mentioned some very interesting tools and solutions that are currently available in the African market, and they are developed for local conditions. And it would be interesting to see if any of these local applications that we have can then be taken over to developed regions. But that's maybe something to look at in a few years' time. But Ejikewu, do you see blended finance and innovative financial products helping to mitigate credit risk in Africa? And do you have some examples that you could, also put on the table?
Absolutely. Like I had said earlier on, the financing gap between, what we need and what is currently available, that gap is widening. And as Africans, we have to be starting to look inward than outward. If you look at the global dynamics playing out at the moment, this is also a good reminder that we cannot outsource development. Development has to come from within. So looking at different financial instruments, developing our own domestic capital markets, because the resources are in the continent. Many of our pension funds, for instance, are invested outside of the continent. Our sovereign funds are invested outside of the continent. And most of I don't know if you can even call it investment, because most of them do not even earn us any interest rate. So if you can bring back that resource that we took outside of the continent and bring it and invest it back in the local economy, that would be a game changer. That is where we see also the African Credit Rating Agency play out some role. Because I have had a couple of conversations with is it IDC, the investment arm of the government of South Africa. And from what we have learned, they are quite interested to invest outside of the South African borders. But the problem is they cannot determine their risk, because simply that assessment is not available. Through the African Credit Rating Agency, we hope to fill in that gap, bring back resources which are outside of the continent, and invest them back at home, and also develop that local markets, countries being able to invest in, each other's domestic capital markets. Because I think most of the resources that we are looking from, the outside world are already existing in Africa. The problem is we ourselves do not have a good grasp of the risk level in the continent, and we're not investing. We're not willing to take that risk and invest, in the local markets. But otherwise, I strongly believe that yes, the blended financing, fintech, all of those are quite critical to develop the financial markets in Africa. And we have to look at beyond even that option, to look at our sovereign funds. Why are we keeping them in Switzerland and in America if, it can get better returns invested in Africa? So, yeah.
Thank you so much, Ejikewu. We've got a question from the audience, but we are really running out of time. But I do want to pose this question, and then we will go into our closing statements. So this is to Marvelous. Do you foresee an African development path that does not involve African countries being rated or being given credits and aid from the DFIs and other external actors?
Thank you, Nicolette. That's a critical question indeed. So I'll answer it in two ways. The first one is that there is a narrative for high risk, high returns in finance, and I sometimes feel, looking at the digits of the Africa creditworthiness. The default rate of African countries is comparative with the other regions. So why the African premium then? Perhaps this is just created to add that return which is associated with high risk. So it partly answers whether I foresee an African development path that does not involve African countries being rated. But this is a very, very disadvantage to African countries. We need to be rated for us to attract much finances that we need for infrastructure deficit projects. So we need that rating to be fair and transparent so that African countries can be in a good position to negotiate with whoever at a comparative scale rather than being disadvantaged already with that African premium element. Thank you.
Thank you so much for responding to that question. We've got another audience question, and Ejike, if you don't mind responding to that, and that is, how can we minimize economic dependence and promote self-sustainability in African economies?
Absolutely. The short and long answer for this question would be African free trade area. We have a mechanism, the biggest free trade area in the world, with our combined GDP of 3.3 trillion. But Africa is the least region to trade among ourselves than anywhere else in the world. So we can create that self-reliance if we really implement the African free trade area. If it is not just an agreement, if it is just not one of those initiatives that African Union initiates and we see it dying, which I hope it won't be the case for AFCFTA, but if we can implement AFCFTA, if we can start trading among ourselves, that's how we build self-reliance, and I think economies that are quite resilient. Yeah.
Right. Thank you so much for responding to that question. And it's time for us to have some closing statements, and I do want to end on a very positive note. So, Ejike, what is the long-term outlook for Africa's credit ratings, and what steps need to be taken to ensure sustained improvement?
Thank you for that question, Nicolette. And my answer would be, in the long term, the answer that, at least from the African Union point of view, is that we need to diversify credit opinions. And that is precisely the reason why African Rating Agency is being established. We need to be able to tell our narrative, to be able to tell our stories, and diversify that opinion that is there, which is, in my view, is a very skewed opinion of African credit risk. So in the long term, we hope that the African Credit Rating Agency will be a game changer, will be able to provide opinion about African countries in a way that other rating agencies were not able to do so until now. And that's where we see, improvements coming through. And, obviously, we need to work on our macroeconomic fundamentals. There is no doubt about it. We need to improve, our economic growth. And all of that hopefully will be reflected in the rating that we will be receiving from all the rating agencies. Thank you.
Thank you so much. And Marvelous, for your positive closing statement, how can regional economic blocs such as the AU, ECOWAS, and SADC help address credit risk collectively?
Thank you, Nicolette. So this question has been answered by my colleague. The issue of free trade area is paramount in combining the interest and the objectives of all those regional blocs that you indicated. But in short, credit risk in Africa is not only a national issue, and you are right, Nicolette. It has some regional implications. Fragmented efforts rises cost, they slow reforms, but collective and strengthening negotiation is powerful. So it can also boost investors' confidence and lower systematic risk. So there is need for all these regional blocs to come together as one. And Africa's regional bloc are more than political reforms. This has to be noted. They are just more than political reforms. They are economic stabilizers. So, by promoting harmonized policies, pooled instruments, cross border investments, they can play a fundamental role in reshaping Africa's creditworthiness and lowering risk across the continent. Thank you.
Thank you so much, Marvelous. So in closing, thank you to our audience for tuning in for this discussion into Africa's credit risk. I trust that our guest speakers have given you insightful information to work with. We will play out with 2 information slides, so please keep your QR code reader at the ready. The first slide is for Inlet Africa registration, and the second is on how to access content for free from ESI Africa. Note too that this webinar has been recorded and you can access the on-demand on the ESI Africa website, as well as our post-webinar article on this discussion that will include the second poll question results. My thanks to our expert guest speakers. It has been a wonderful discussion and I really enjoyed hosting you on this virtual session. And lastly, to our finance and investment volume partners, ICO Solar, GE Vernova, and South African Airways, thank you so much for participating in our volume. And yes, to a financially secure future for all. Stay safe and goodbye for now.